Today's session would be facilitated by Mr. Brendan James, who is no stranger to the IOSH Caribbean branch. He is currently the Vice President, one of his many roles, of the Sustainability Institute of Trinidad and Tobago. Brendan has over 21 years experience in the energy sector, with his industry experience spanning along the natural gas value chain, drilling and workover operations, exploration, production, refining and marketing, asset management, as well integrity, as well as power and utilities divisions. Brendan currently holds a Master's of Business Administration and Sustainable Energy Management from the Arthur Lockjack Global School of Business Management. He has an MBA with a focus on organizational effectiveness and culture change from the Anglia Ruskin University. He holds also a Master's of Science in Occupational Safety and Health from the University of Greenwich. And he is one of my former colleagues from our time at the IOSH agency. So welcome, Brendan, and we all look forward to hearing this presentation on the sunk cost fallacy. Brendan?
Thank you, Rishi, and I want to say thank you to the IOSH team for asking me to come to do a presentation on something that I'm really passionate about. So I think I wouldn't start with normal convention. I'll start with a little bit of a joke, kind of ironic. So we're here to talk a little bit about energy and energy projects. However, I just lost power this afternoon, so I actually have no electricity where I'm at home. However, because of the devices that I own, I can still stream. So thank God for that. So I'll definitely be talking a little bit about resiliency today. So my topic here is a little bit of a quirky name called the sunk cost fallacy, decision making under uncertainty. And when Jason had asked me, if I'm willing to come to speak to the IOSH group again, I said, yeah, I'm working on this little idea I've been playing around with in my mind called the sunk cost fallacy. And he looked, he at the time he paused on the phone and said, who the target group is? I said, yes. But he trusted me to use my little bit of quirkiness to share interdisciplinary issue that I'm looking at, right? So this is my presentation. And of course, any questions as we go through, feel free to ask it to the end and answer it as best as I can. So Rishi did an excellent job in terms of the introduction. This is who I am, my background, my educational background, multidisciplinary in different areas. But what I have on the right of the slide is really what I'm passionate about as well. So I'm a podcaster, but I actually, with a couple of other guys, we run a social commentary podcast called Inquisitive Minds. And this is what I'm passionate about, creating platforms for people who are actually doing positive things for Trinidad and Tobago. And I'm also the vice president of the Sustainability Institute of Trinidad and Tobago, which is an initiative that would have been started with someone that you all may know very well, Jason. And this is something that we think is important for Trinidad and Tobago. So what is on the right is really who I am. So, in my presentation, you can kind of get an idea of my focus and my space and why I speak about certain things in a particular way. So I have a confession to make, and because I have a little bit of a bias, and my bias is that I think there can be much more HSC professionals getting into sustainability because there's room for all of us. The sustainability movement in terms of what we have to deal with, in terms of climate change, in terms of dealing with sustainability strategy and environmental management systems throughout business, government, and services. I think it's not only for engineering professionals, not only for policy professionals. I think the HSC professional should get more involved because of our background. I think we have a unique voice and a perspective that really matters, right? So what is this sunk cost fallacy? Sounds weird, but the sunk cost fallacy describes our tendency to follow through on an endeavor if we have already invested time, effort, or money into it, whether or not the current costs outweigh the benefits. And that's simply the definition. So the sunk cost fallacy should sound a little familiar to us because the sunk cost fallacy is really about human behavior and culture. So we spend money behind an effort, even though the benefits surrounding what we spend is not going to achieve the future objective that we want. And I'm going to get a little bit into what that means in terms of real life. But this is the definition that is the standard definition that is normally used. So I'm doing a little bit of cross-functional integration here. HSE, organizational culture, business risk, all interconnected. And I want to show using the example of Kodak. I'm hoping everyone is a little bit of a history nerd like myself. Did you all know that Kodak invented the digital camera? Not a lot of people know that. However, has Kodak been a large name in the digital camera space? Answer is no. Why? Where is Kodak now as a company? Don't hear a lot about them in terms of products and services out there. They still do exist though, right? But if you think about Kodak, Kodak was $1 billion company, right? They invented the digital camera, but they tanked the project because at the time, the Polaroid camera and that technology was making them billions of dollars. Does this sound familiar? Where you reject something that doesn't fit into the narrative, into the way how things are done, because you sacrifice that for the existing status quo. And that should be familiar to us. What is the definition of HSE culture? For me, I always remember HSE culture is defined as this is the way we do things around here. Or as I was told a few years ago, enter into the power sector. We're doing like this for 30 years. Who are you? It's defined in different ways. But this is the cross-functional nature when I'm talking about this whole sunk cost fallacy and linking it back to the same sort of behaviors we see and same sort of decisions made dealing with agency matters and even when we're dealing with business risk. So all of these things interconnected should sound familiar to us in terms of decisions made. And as we think about that, and my foray into this whole interdisciplinary area of thinking, I actually had a couple of people who I would consider heroes. On the right, I have Dr. Amos Tversky and Dr. Daniel Kahneman, who would have won the Nobel Prize for Economics. And they would have trained and mentored to Dr. Richard Thaler, who won the Nobel Prize for Economics after them in 2017. But the funny thing about it is Dr. Amos Tversky, who passed away before he was awarded the prize, alongside with Dr. Daniel Kahneman, are actually psychologists. Have you ever heard of that? Psychologists winning the Nobel Prize for Economics. Very, very interesting. And they would have been some of the pioneers behind an area called behavioral economics. And Richard Thaler would have been an economist who would have taken it to the next level. And essentially what I'm talking about today has to do with behavior. So even though it's about decision-making and finance and projects, it really comes back down to culture and human behavior and how we make decisions. So what I'm going to show now is a video clip of one of my favorite movies based on the 2008 financial crisis, The Big Short. And this is actually Dr. Richard Thaler, the same guy that I showed before, and Selena Gomez, talking about the financial crisis and what occurred. And they're talking about CDOs, something called collateralized debt obligations. But it doesn't matter what the details of the CDO is. It's how he utilized the concept of it, of people making bets on mortgage products and making the mistake in terms of falling into a cultural trap, right? So just listen to this video. Talks about another fallacy, but it kind of gives you an idea of where my presentation is going.
Well, here's Dr. Richard Thaler, father of behavioral economics, and Selena Gomez to explain.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. Bet you 50 million she wins, and I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
You okay?
No. Right. So in the video, you would have heard Dr. Thaler talk about the hot hand fallacy, right? These exotic financial products that people were betting on that will always continue to grow. And if you remember back all the way back in 2008, this crisis had the potential to put the entire globe in a recession. It would have been extremely devastating to the lives of everyone on the planet if the financial system had crashed. So this is a serious, serious issue. But let's pivot to sustainability and business strategy. And let's run a thought experiment. You're part of a senior executive team, an organization that has invested, let's say, about $100 billion in assets in the energy sector. And you're looking to create new projects to generate new revenue to assist the business to grow and to meet the expectations in terms of revenue and profitability for the executive team, your shareholders and existing debt financiers. This is a typical organization, typical, let's say, energy-based organization. So your shareholders has had a vote. And this scenario should sound familiar to you because there are many energy companies facing the same scenario. The shareholders had a vote and they said that the organization must reduce its greenhouse gas emissions in terms of their business, right? So a resolution has been passed, right? But the investment in these ventures, when you look at your budget, will cannibalize the existing $100 billion investment because you're going to have to reallocate money that you would have invested in a $100 billion business into new ventures that will reduce greenhouse gases, right? Also, you're also looking at the fact that the renewable energy technologies, for example, as one of your strategies you're considering, has very high upfront cost. The question is, will you do it? I think the easy answer is yes. Everyone might say yes. The responsible executive will say, yes, I'll do it. But incentives matter. And one of the things that we note is that your management team, some of them are personally millionaires, right? Has gotten wealthy, shareholders, stakeholders have gotten wealthy off that $100 billion investment. And post-pandemic, when you look at the energy prices, you're making a lot of money. So to say yes, but to actually invest what is required for the future is something that is very difficult to do, if we're being honest, because of the incentive structure, right? And there's also a critical metric inside of there that we utilize for investment when we're looking at projects called the levelized cost of energy, all right? Or levelized cost of electricity, LCOE. When we look at the lifetime costs associated with investment assets on the energy side, that you're allowed to make your financial or make some level of financial decisions about choices. So let's look at that. So in Trinidad and Tobago, we hear different opinions, right? People saying that, we already have, and I'm using power as an example. In the power sector, We already have natural gas generation. It is relatively clean. We do not use oil-fired generation, for example, and we don't use coal. So we're not contributing as much to the greenhouse gas impact. However, there's also other issues associated with where we are. And when you look at the investment decisions in terms from a cost perspective, right? Our existing units, most of our existing units are normal combustion turbines. You'll see it in the second row that I have circulated there. Has a very low capacity factor of 10%. And when we look at the levelized cost, which is the upfront cost and the operations and the maintenance cost, right, is about $107 US, right? Combined cycle, look at the difference, right? And so the question is, why aren't all our generation in the country combined cycle, for example, right? And even below that, I just use solar as an example, a lower capacity factor. However, look at the LCOE. Solar standalone is lower. Solar hybrid, in terms of when you combine solar, for example, with batteries, is just a little bit higher. And I could make an argument for that $45 cost, even though combined cycle is a little bit lower. If I look at something called the opportunity cost, which is the money that could be made from selling natural gas to the open market or making ammonia or methanol or whatever else, other products, that high value products, that I can make an economic argument that solar hybrid is something that will benefit Trinidad and Tobago. So when you have to make a decision around making investment in new services, this is the process that you have to use. And this is the process that is normally used. So the bigger question in that is why? Why aren't we utilizing the numbers to make the decisions? So let's look at another data point, which is the capital cost of fuel-based or thermal-based energy-related systems, or looking at renewable energy technologies. Now, this is the capital cost from Goldman Sachs that they would have looked at in terms of the money or the interest rate that the banking sector will charge on projects for the different technologies. That line in black is offshore oil. Pink is LNG, and you could see solar, offshore wind, onshore wind, offshore wind, and renewables on an average as the other colors on the graph. So even though the upfront cost for a renewable energy technology may be higher, the actual interest rate that is charged on the loan that for the money borrowed to actually develop these projects is lower. So your overall capital project cost is lower. So if this is the situation, why aren't we investing more in renewable energy technologies? When from a cost basis, it is much cheaper. What is keeping us back? Because the numbers are clear. Some other data points, right? More from the narrative point of view. So the IEA is saying that, listen, peak oil demand, which is a concept, and very simply that oil is, you're not going to have a situation where you're going to have peak oil supply. We have hundreds of years of the supply of oil and gas. You're going to have a situation where demand is going to level off and eventually fall. And what they're saying is peak oil demand is going to happen in 2025. They're predicting that, right? Based on the data, based on policies, based on analysis, right? Some of the other companies, for example, and I'm quoting here Dale Spencer from BP, he's saying that it's not enough to simply consider the marginal cost of extraction and developments in the social costs associated with production of oil and gas, and that it is likely that these social costs are going to have an important bearing on prices in the future, right? And then you're seeing the IAB, the Inter-American Development Bank, the IDB, is speaking about the stranded asset risk associated with traditional energy assets. So if the financial system, in terms of banking and insurance, they are all very concerned about the profile associated with the traditional investment. But yet, we're not investing as much. And just another projection from BP, they actually believe that peak oil demand has already happened, right? They came up with this in 2020, right? Which means that even though we're experiencing extremely high prices now, it is expected to fall and fall rapidly in the next decade. So sometimes I hear different commenters in news and in energy. We'll talk about, oil and gas will always be around. And I tend to agree with that. I think it will always be around. But I don't think that is the right question. The question that will oil and gas always be around. I do think that's the right question. I think the question that we need to start asking ourselves now is what will be the size of the market as we think from a Trinidad and Tobago perspective in terms of most of our revenue coming from oil and gas, right? What will be the size of the market? Will the oil and gas be produced the same way, right? And can we compete? Those are the questions that must be answered. And if we are very honest about those questions, we will start realizing that our investment profile on sustainability, renewable energy technology needs to ramp up very quickly. You see, the problem is not necessarily that the numbers not adding up. The economics is clear. To me, the problem is about change management. And the question is, are we tied to the past investment that we have already made, thinking that we have time to optimize the asset to get all of the value, and we could pivot just in time? So we make as much money as we can out of the oil and gas systems that we set up, that $100 billion investment, and we will change just in time before those assets become stranded assets. Now, if the answer to that is yes, then you have to tell me when is the right time? What is the right signal that we need to pivot our billion-dollar industry? What is the signal that we need that will make us comfortable to be able to switch our investment strategy to one that is a little more aggressive? Back to the Kodak scenario. Now, it's easy to turn and look at Kodak and say, listen, they made the wrong decision, but that's hindsight bias, right? And to quote Mr. Mariano Brown, when we had this discussion a few years ago at the university, he would have been telling us in the sunk cost fallacy Trinidad definition, we're spending good money behind bad, right? Not that the investment that we have has not paid off amazing dividends for us, it has. But there is a time in which we have to start looking at the investments and start looking at diversification in an aggressive way because of where things are going. How much more should we be investing to fast track the transition? So the sunk cost fallacy is about this. If I am looking at my existing portfolio and I'm spending money to maintain it, but not spending enough to diversify, eventually my business will be disrupted. And then it's a Kodak scenario all over again. So some questions. Should we be spending more to diversify, to reduce the greenhouse gases from our business profiles, to save the planet, right? 1.5 to stay alive, to make a lot of money. And I have a lot in red because there's a lot of money to be made, right? Then why aren't we doing it? Is this the sunk cost fallacy? Right? I think the answer to that is yes, my personal perspective. And there's some arguments in here that I deliberately left out, right? And these are some arguments that I would have made before. One, the European Union should be passing very soon, I'm hoping, a carbon border tax mechanism, right? And we could get into it a little bit through the questions, but think about the carbon border tax as if you are selling your products, goods and services to the EU, and through the manufacturing process, for example, you generate a lot of greenhouse gases. You may have to pay a different tariff than somebody that is not. And once that happens, the US will retaliate, quote unquote, in terms of introducing their own tariffs. Now, the thing about change is that you don't need everybody to change for the market to change. You just need the right players to change. So, for example, the US housing market was 1/12 of 1% of the entire financial system, but it almost destroyed the entire financial system. If I have the largest players, the EU and the US, setting up some sort of carbon border tax mechanism, I think that is going to impact all of us. carbon pricing is becoming much more politically popular. And once we start seeing those carbon pricing legislation and regulations start passing in countries, it's going to start impacting global trade and global business. The financial regulators worldwide in different countries are setting up rules with regards to disclosure of business in terms of in the public market, ESG regulations, environmental, social, and governance frameworks for businesses, right? The most recent one being the Securities and Exchange Commission announcing that they will be setting up rules for companies who are claiming to be green to be able to demonstrate that through specific guidelines. And one that I'm pretty excited about, the IFRS has established the International Sustainability Standards Board, where they will establish rules for accounting. Now, this is huge. A business lives or dies based on accounting. And you have the body that sets up rules for accounting that says, listen, rules, for example, for things like materiality and how you recognize certain risks and how that reflects on your balance sheet is going to be putting sustainability front and center at which a company needs to demonstrate its accounts. This is going to change everything about how we do business. So in closing, the question is the traditional energy, car manufacturing, heavy and light industry being disrupted? And I think the answer is yes. And to quote Clayton Christensen, one of my favorite authors, who passed away recently, may he rest in peace, a disruptive innovation is a product or service that is unattractive to established leaders in an industry, right? Until you can't deny it anymore. And I do think so as well, and I agree with him. Thank you for listening, and I will close off there. I ask if there's any questions.
If you have any questions, you can post them in the chat. I will also share in the chat contact information for Brendan and the Sustainability Institute, so you all can get follow along there. We have a question, Brendan. How effective will a carbon border tax be in a business environment where certification by unethical bodies means that reported values for the carbon burden on the goods cannot be trusted by the EU? Certification standards such as 14064.
That's a good point. So there's a couple of ways in which we are thinking that there's some level of cross-reference, right? So let's go through a couple of scenarios. One, if you have scope 1, scope 2, and scope 3 emissions, right? So scope 1 emissions are the emissions that you will generate as a business. Scope 2 emissions, for example, would be those that are connected to your business, let's say like along your supply chain, those that are inputs into your business, like on the power side, water side, and so forth. And then you have scope 3 associated with those who you sell your products to in terms of the carbon or greenhouse gases that they develop, right? Or they generate. Now, there are a couple of ways. One, there's a national reporting framework associated with COP and the Paris Agreement that is a requirement. There's established assessment that is being done at the national level through all of the inputs, for example, water, power, all the things that are inputs into your system that will make up part of your carbon footprint. And one that may sound like it's incredulous, but I'm not sure if people are aware that the NGC had just recently signed a contract that allows for satellites to actually help monitor the possibility of methane leaks. I can tell you for a fact that there are many international bodies that have satellites that are actually over countries monitoring greenhouse gas releases. So even though they may not be able to get exact figures, but you can make some very strong estimates around what is a possible carbon impact around certain products and services based on the industrial profile. And it may not necessarily be integrated or boiled down to an individual small and medium enterprise as yet. But I think for the larger enterprises, it's going to start with them, right? And there are more mechanisms that are being developed as we go along, as this thing rolls out. I hope that answers the question.
Brendan, if I may, while the rest of the members and audience think about questions, what is the role that you see health and safety practitioners playing in transitioning to the green economy and more sustainable minded?
Thanks for that, Jason. I think the HSE professional, we should be the starting point, because environmental strategy and environmental management is part and parcel of our portfolio and part and parcel of our responsibility in terms of advising organizations, in terms of managing. The sustainability movement is a natural extension of that. Our training in risk management applies across the board. And the presentation, what I was trying to show that our understanding of human behavior and decision-making and culture extends to even when you have to make a financial decision. So my hope is that the HSE professionals start seeing themselves as integral in the strategic options analysis that is done by companies. When a company is thinking about new projects and development, to be part and parcel of that conversation. I mean, most times we are in the room where those decisions are being made, and you're able to now speak to what are some of the sustainable initiatives associated with your project ideas that could help it improve. So for example, when we were discussing certain projects at work, I started talking about levelized costs. So there was a discussion about buying, for example, new generation or new generator versus looking at a solar project. And the argument at the point in time would have been that upfront cost. But there's no way, when you look at the numbers, that it is much more economical to go for a traditional thermal generator, because when you look at the levelized cost, when you consider the operational and maintenance cost for an asset like that, it is going to be much, much higher, much more expensive. So the HSE professional being part and parcel of that conversation there in the room, asking the questions, challenging the technocrats, saying that there's better ways to do this, or there are other ways that we should consider this, is part and parcel of what I think the professional can add value, where the professional can add value. So it is using the same skill sets that we have, the same understanding human nature, human behavior, and understanding that, listen, these decisions are made by human beings, even though the numbers add up. People still making the decision not to invest as much as they can. And we need to understand why, and we need to push the envelope.
Yeah, thanks for that, Brendan.
No problem, Jim.
So just following up while I give Rishi a little break. So the first question, the questioner was appreciative of your answer. They did make a comment that, you know, they could potentially see some disputes at the World Trade Center based on that.
Yeah. There's going to be a lot, yes, yeah.
We also have another comment, great presentation. How would you approach the sunken cost fallacy for a country like Guyana that's experiencing a boom in their energy sector?
That was a tough question, boy. I think there's a balance that has to be struck. And I think there's some significant lessons learned that should be adopted, if I be bold to say. The oil and gas sector in Guyana has to be seen as something that has a time limit. And if we don't embrace it in that particular perspective, then some of the mistakes that were made in the past in other countries could be made there. Now, you could do, and I like the Norway model, right? Norway would have invested huge amounts of money in their oil and gas sector, would have reaped the rewards. They would have had their strategic investments similar to our Heritage and Stabilization Fund. Theirs worth trillions of dollars. And they utilize that money to heavily invest in green infrastructure and in preparation for the transition. So it's about smart investments now for what the future is going to be. And if that is not done, then you could end up in a scenario where you have a number of, you have billions of dollars in assets that you can't really use. So it is about making sure that the finances flows to the projects that gives you the best bang for your buck. And to the extent, it might be very difficult to actually do anything else, because those interest rates will have a way of convincing you that you need to spend your money elsewhere, all right? In terms of where the lending is heading, in terms of banks pushing companies towards certain technologies.
Yeah, thanks for that. Again, another comment. I agree with the Norwegian model. So there's someone who is supportive of what you said. I mean, if yeah. I'm not I don't consider myself a energy or a economist or an expert in those fields, but I had the opportunity to be in Guyana in February of this year for the energy conference. And I think that based on what I heard, the Guyanese government is quite clear that oil and gas is really a transitional medium or mechanism for really the development of the country. Now, yes. When I say they have put costs associated with their forestry, and they could tell you exactly how much it's worth, and they've even articulated, even with the oil and gas boom, they are still carbon negative.
Yes.
Based upon how they've monetized and their emissions. So I think there's a lot of work that has gone in by several countries. You know, there's what Costa Rica has done as well for a country that may not be the first that come on the top of people's head as being one rich in fossil fuel. But the reason why I throw Costa Rica out there is that it shows that regardless where you are as an entity and what you're blessed with, the model around sustainability is still something that can be successfully adopted by various organizations and countries.
Yes, very much. I agree fully. Thanks for sharing that.
Brendan, we have another question. What are your thoughts on the culture of corruption impacting national investment in Norway versus the Caribbean?
So I remember a few years ago, I was having a discussion with an economist about corruption. And, you know, we were talking about corruption that is systemic. And when we got down to, you know, looking at corruption, looking at culture, human behavior and stuff like that, we boiled it down to perverse incentives. A lot of times we have corruption because the way things supposed to get done doesn't work properly. And corruption is sometimes, not in all cases, but sometimes corruption is utilized to probably push an agenda, and then, well, people will line their pockets. Now, a big part of the challenge that we have, and this impacts the whole argument that I'm making with sunk costs and renewable energy investment, it impacts even traditional oil and gas investment, is what we call the ease of doing business. You hear people talk about it a lot. People say, you know, we have to deal with the ease of doing business. But the ease of doing business solves corruption issues as well, right? The countries that has very low corruption index, look at their ease of doing business profile. I challenge anybody to check it out. Look at their ease of doing business. The countries that do not have a lot of corruption have very strong systems. However, they have systems along the ease of doing business that facilitates business and not a hindrance to business. So it even means the structure of like how you structure your policies and so forth. Those things matter, right? So to talk about it in terms of a comparison, I would look at it through the lens of incentives. What is the incentive? And ease of doing business. So for example, I should have an incentive structure where the choice between a gasoline-driven vehicle and an electric or hybrid vehicle should be easy, all right? And this is the work that Richard Thaler would have done. He would have gotten people to enroll in pension plans, increasing it by about 80-90% by automatic enrollment. So you're automatically enroll in a pension plan and you need to write to the business or organization saying, I don't want to be in the plan, to get more people to save money. So the structure of your policies to get people to change their behavior is important. So I will answer that question from the point of view of, listen, we need to deal with things like ease of doing business. I shouldn't have to go through 10 different agencies just to decide I want to put solar on a commercial building or I want to put up a small wind turbine, all right? So that's my thoughts on that.
Okay, there's a comment here from Devendra that said Costa Rica had strong government support for renewable energy and they are seeing the benefits now. It's a good example of the positive effect of government policy and consistency. And it kind of rolls into a question I have in terms of how do you see, in the UK in the mid 2000s, early 2000s, there was some shifting of, yes, we go green, no, we don't go green. Or one of the prime ministers at one point in time saying, cut out that green crap. And now they have ridiculous energy prices. And it's a bit too late now for them to jump on the renewable energy train. And even if they do jump on it, there's steady money there that is available. So what are your thoughts in terms of those high energy prices right now, in terms of hindering sustainable options and long-term investments?
Yeah, so the UK and the European Union are experiencing significant challenges right now because of what is happening geopolitically, right? Now, I mean, we can make an argument about speed of transition and things like that, but the whole geopolitical framing around oil and gas and the reliance of specific actors to be able to be consistent in their supply has changed. So I'll answer that by saying that even if that is going to be a challenge and the next 2 years is going to be painful, they do have a choice. Should they have done it sooner? There could be an argument that could be made towards that. Could they have been more aggressive? And they have. I mean, the UK was generating, let's say on the power side, maybe about 50% of their energy from renewable resources at one time, which is pretty good. But understanding the whole aspect of energy security, and energy security is more than just conflict, right? I mean, our blackout in Trinidad and Tobago is also an energy security dialogue, right? So the whole concept around energy security has now maybe starting to get the respect I think it deserves, right? So I would say for that particular question that the UK and the European Union, I think they have been making a lot of strides, but looking at the geopolitical reality and what is happening now, they don't have much of a choice to get more aggressive. So in Trinidad, Palan still had to find the money to get done.
Right. Thank you for that. Any more questions from anyone before we wrap up? Okay, and in the chat, I just wanted to, before I thank Brendan for his presentation, I just wanted to remind everyone that there is contact information for Brendan James, the Sustainable Institute. You can go to their webpage, you can email him, you can follow them on LinkedIn. They also have an active Facebook page. So, like and subscribe. And again, Brendan, thank you very much for taking the time out to deliver this presentation. Always a pleasure, always welcomed in the Caribbean branch. And thank you all for attending. And for our members, we do have our AGM coming up. So stay tuned for those committee mailers. And you will see an invite coming up. Well, there was one sent 2 weeks ago. So look out for reminders. Thanks again. And everyone do have a safe and productive weekend.
Thank you, everyone. Be safe.
Thanks all. Bye.
Thank you. Bye.